Did you know it's a way to put money into an account and write it off on your taxes? But take it a step further. With that same account, you can take out money out that account and not pay taxes. Is that possible? Yes, it is. You can put money in, get it for a write off, take money out tax free. That's how we get to the bag and have the money stay in our pocket. So, what account is that? We're going to let you know, and we're going to let you know as a business owner or a W 2 employee how to do that and make us some money and have more money stay in our pocket. Y'all ready? Lego!
And you just wanna get paid. Tired of making no money mistakes. Make a payment on your bills and you still late. Yeah, painful profits to help you seek change. And you just wanna get paid. Yeah, tired of making no money mistakes. Make a payment on your bills and you still late. Painful profits to help you seek change. Yeah, cut the show and just listen. You wanna feel empowered by making money decisions.
So, what account is that? That is a HSA. And what is a HSA? It is a health savings account. Now, we've heard of it from time to time, right? Especially when we do annual enrollment, insurance agent comes out, HR comes out, sign all this paperwork, get into this new plan. I can't get jiggy with this. I don't know what it is. But we're going to help you guys decide why doing an HSA is a big bang for your buck. And sometimes it's a way for you to grow your investors more than what you could possibly think. We're going to talk about that and talk about how to use the tax code to our advantage with an HSA. You can even have your meals by chef or by meal prep done and not pay taxes when you spend that money. What? Really? Let's go to the screen. Yes, indeedy. Health savings account. It's called a HSA, health savings account. And we have contributions involved, right? We put money in, it's a write-off. Look at this. So what's a HSA? It's a health savings account, and it's tax advantage. It's designed to help individuals and families take advantage of paying high medical expenses because we know health insurance is high, medications high, medical expenses high. As I'm losing my voice, everything is high. So the federal government said, you know what? We're going to make it easier and more affordable for individuals and give you a tax break if you use your money towards medical expenses. But with the tax code, it's a way to go on and weave, right? Because we have triple advantage. Not one, not two, not three when it comes to HSA. The first one, contributions are tax deductible. What does that mean? That means anytime we put money into that HSA account, we get to write it off on our taxes. $4,100 as an individual or as a family, $8,300. So for instance, if I'm a family and I put in $8,000 in my HSA account, I'm in a 25% tax bracket, $2,000 write-off. By putting money into something I know I'm going to spend later down the road, kind of like a 401k or IRA. A little bit different though, my profiteers. Number two, the funds grow tax-free. Yes, like a traditional IRA or 401k, they grow tax-free. So as the money grows, we're not paying taxes on it. But here's the kicker. Withdrawals for qualified medical expenses are tax-free. But the good thing about medical expenses is that it's vague. What's a medical expense? Is it medications? Yeah. If I got high blood pressure and my dietitian puts me on a low cholesterol diet, is that a expense? Yeah. If I got to go to the chiropractor because my neck, my neck and my back hurts, is that a medical expense? Yes. So you mean I can take it out my HSA where I make money and it grows tax-free and I take it out? Yes. That is why you do both things. Write it off and then use it tax-free. And we can have it grow as well from an investment standpoint, which we'll talk about. So who qualifies for it? Well, it is a qualification, right? You have to have a high deductible health plan, HDHP. We'll talk about the second though. Pretty easy to get. As an employee and definitely as a small business owner, very easy to get. And it's contribution limits. We can do no more than $4,100 a year for an individual, no more than $8,300 a year for a family. Now, family could mean husband, wife, wife and wife, husband and husband, whatever, or it could be a person with their child on their coverage as well. That counts as a family. So that is the HSA. We're going to get to the nitty gritty though, and how we can get to the bag, keep money, the bags of money we got in our pocket, and then also have it grow. Next, so here's the kicker. Banks and investment companies offer HSAs. The top banks and investments for HSA accounts. Not a recommendation, just information, right? First, Fidelity, right? Fidelity. They allow you to actually open up an HSA and invest the money. So instead of it sitting there collecting dust, making 1, 2, 3% interest a year because it's better than what it was 4 years ago because of inflation, you actually can invest the money. You get to pick the investments just like it's a 401k, just like it's the IRA. Do your due diligence, research the investments, but you get to invest the money. So now we put it into the HSA, we write it off, the money's growing tax-free, and if we do our investments properly, then guess what? We're making money from our investments. Sounds like a traditional IRA and a Roth IRA in one. Yes. Also another bank, HSA Bank, right? They're cool because they actually integrate with most, not all, never say all, but with a lot of insurance companies, they integrate with HSA Bank. Now with HSA Bank though, we don't have the investment options as a Fidelity. Not a recommendation for Fidelity. I cleared through all Truist, so I definitely recommend a Fidelity. They're cool, but it is what it is. But HSA Bank does give you a smooth integration with most insurance companies. So when something's paid, they can just take it out the bank without you having to take it out the account, put it to your bank account, and then, send it to them, right? So it's a lot easier from an insurance company with HSA Bank. The third one, Bank of America. We all know Bank of America. Very easy. They have some investment options, not as robust as Fidelity, but Bank of America actually has an HSA account as well. And if you want something like traditional banking, right, if you have a Bank of America account, easy to move from one to another. So it's pretty easy. And then the last one, you have Optimal Bank. It's great because Optimal Bank is optimal, especially for employers, right? If you're a small business owner, it's very easy. Their platform is user-friendly for employers. And the key thing with employers, you can do the best of both worlds because we know our employees might not always invest money we put into their 401k or their SEP IRA, but we know they're going to use it properly when it comes to health insurance. And for small businesses, we know health insurance is a big driver of employee retention. So as an employer, you're telling me I'm able to write it off because I put money into my employee's HSA account? Yes. You're telling me as an employer, I get to keep my employees happy because they have money to pay for medical bills? Yes. You telling me my employees are going to be happy because their money's growing tax-free and they can take it out to pay medical bills? Yes. HSA is a big reason why larger companies have client retention like they are. So if you're a small business, look into having an HSA for your employees because your employees will use that to their advantage. People all the time don't get into investing, but they get into paying health bills. My kid's sick. I could take money out this account, out my bank account, and it's tax-free too. They're going to stick around for that. What's next? So I'm going to give you guys a real life example because in real life, I'm a certified financial planner. I've been practicing for 18 years. So we have multiple clients who work for W-2 companies and also 1099 employees that use HSAs. It's a big driver of my practice because it's ways that I add value more than you making money in the stock market. Now, yes, our clients make money. Historically, we outperform the stock market, but adding value besides an account that you don't touch from an investment standpoint, That's how you drive revenue, in my humble opinion. But Alex, a client of mine, he contributes $8,000 a year to his family HSA. Now, Alex is not married, but he has his child on his plan, so he still qualifies as family. And we've been actually been doing this for a long time. 10 years. Again, I've been practicing for almost 17 years. I know I look young. I got these gray hair, these gray waves. I got them. I do look young, I know. But yes, Alex, we've been doing this actually for 10 years, right? So he invests the funds and he's making 10% a year, right? I mean, heck, this is an index fund, right? So we're not getting too aggressive. I would say for your healthcare, you don't want to be too aggressive. Check your risk tolerance. But in an index fund that does good in the good times, does bad in the bad times, but historically the market does go up. So his is making about 10% a year. Not saying you're going to make 10% a year in your HSA account. You might make more, you might make less. But in these diversified index funds we have in his HSA investment account, he's making about 10% a year. So after 10 years, he now, I would say should, right? Because we have to should, hypothetical, but in real life, he's now at about $130,000. We round up a little bit. He's at $130,000. So over 10 years, he put in $80,000. And guess what? All $80,000 has been a tax write-off. So in 10 years, theoretically speaking, in the 25% tax bracket, invested $80,000, I've got $20,000 in write-offs. That means $20,000 stays in my pocket. And that money has grown tax-free for 10 years, now to the tune of almost $130,000. And if you use this for medical expenses, guess what? It's all going to be tax-free. This is used as an accelerated retirement account because as we get older, what happens? Oh, my knee hurts. I need a knee replacement. Oh, I fell. My elbow hurts. I got to get a joint replacement. Oh, my teeth is going crazy. I got to get new teeth. Stuff happens as we get older. So instead of having coming out of our checking and savings account that we pay taxes on with that pension or taking money out your 401k, we got this beautiful HSA account that's grown over time that can pay our medical bills. This is why planning is so important. But we could take it a step further. You might just need it year by year. Put in the money, we write it off. Kid gets hurt, got to put a cast on the knee. Take it out the HSA account, tax-free, instead of coming out your pocket where you pay taxes already. That's why we can write it off and then have it grow tax-free and not pay tax when we take it out. But another great thing about it, we can actually use an HSA just like a 401k. After age 65, you want to take out the money so you're healthy, you're strong, like an ox, he-man, she-man, and never needed to take it out. Well, after age 65, guess what happens, y'all? We just take it out. We pay taxes just like it's a 401k, like it's an IRA. You pay taxes at your tax bracket. So we're 66 years old, got to get that ankle worked on. Been playing tennis for too long. My ankle's hurt now. Take out that $10,000, your tax on your income bracket. And prayerfully, since you're older, lower tax bracket, maybe not, get into the bag. I don't know. But you can actually use it like it's a 401k from a tax standpoint or IRA after 65. No penalties either, just taxes. So that is a real life example of one of my clients right now who has used the HSA for about 10 years. Look at that, y'all. Next. But it doesn't stop there because as a small business owner, I can open up an HSA as well. I can have a qualified high deductible health plan. And as I said before, that's when the beauty of employee retention rears its beautiful head because I do need an employee plan. But from a write-off standpoint, we know when we pay for our employees' insurance, we write that off. So that's a write-off. And now we're putting money in your HSA. That's a write-off. Money stays in our pocket as a business owner. And you can open up an HSA independently as long as you meet those requirements. And also employers can contribute HSAs to the employees. So you can do a SEP IRA. You can do a solo 401k and then do that 3% to the clients. Excuse me, not to the clients, to the employees. But also, if you want to, from a client retention standpoint, put money directly into that HSA account as your employees, you can. And for you as an employer, that's a tax write-off. So step by step, day by day, number one, verify you're eligible for a high deductible health plan, right? Verify that with your employer. If you're a W-2, if you are a 1099, then pretty easy. You can find yourself a high deductible healthcare plan, right? Step number two, open a HSA account. Is one thing because we got to do it now. We see all this game I'm giving y'all, but you got to do it. Step number two, open an HSA with a reputable provider, right? Fidelity, Bank of America, Lively, Optimum, your choice. Your choice, but you have options. Step number three, contribute, I would say, the maximum amount annually. $4,100 for individual, $8,300 for family. Again, $8,000, 25% tax bracket, $2,000 in our pocket. $4,000, 25%, $1,000 back in our pocket. So we're going to pay for healthcare, but we're getting money back to us before we pay, and it grows tax-free. Come on, y'all, if you use it for qualified expenses. That's why number four, very important, because Uncle Sam could be knocking on that door. You could be audited? Nah, probably not. Examined? Probably not. But it's good to keep records. Anytime you do anything from a business standpoint, or you have write-offs that you're using as an employer or employee as a W-2, it's good to have receipts. So track your expenses diligently. Now, the good thing, since everything is digitalized, when you pay for things through your HSA account, it's tracked already. One piece of game, as I talked about, talk to your dietitian. Because if you're as healthy as you can be, but you want to find ways to use your HSA money to pay for things that you use day by day, if you have high blood pressure, high cholesterol, too much salt intake, a dietitian will write this thing called a prescription. Now, prescription tells you to get a certain type of diet. Well, that is medicine. It's a health expense. So you use that prescription to buy you a meal plan, even have a chef to make you meals, and you pay for that through your HSA account. And that is actually a qualified medical expense. Look at that game I just gave y'all. So in closing, you now have a way to put money into an account, write it off, and take money out that account and not pay taxes on it, and have it invested and growing in between time. This is why financial planning is so important. This is why I'm here on YouTube giving y'all game. And this is why y'all should comment below. Click the link in the bio and join our financial empowerment program, because we do have 1,000 clients nationwide managing money and doing financial planning. It's the reason why, because we're here to help you. And I just saved you guys, if you're an individual, $1,000 in taxes. If you're a family, $8,000 if you contribute. And if you contribute, $2,000 in taxes you just save. And that's game. Y'all be blessed. As always, let's make some painful profits together, y'all. Peace.